So in the case of the US, we've had a couple of interest rate cuts, and it's been very, very much in the US interest to have a weaker US dollar because it makes US exports cheaper into the overseas markets, but it also means imports are more expensive, meaning a consumer, if you've got a choice of buying a US good that's slightly cheaper versus an international product that's slightly more expensive, you kind of buy the domestic product.
So looking after your own backyard type thing.
So sometimes a softer currency is no bad thing. That said, as you've rightly pointed out, indications now for interest rates in the US are that the cuts that we were expecting to see quick fire coming into this year, I don't know that we're going to see. Part and parcel of that, we've had some firmer inflation data. I'm not going to say strong, but firmer inflation data. The jobs market has been a little shaky. The geopolitical tensions and an assortment of other bits and pieces through that mix, whereby I think a wait and see before cutting rates is quite prudent. And I'd say if Michelle Bullock had a time over again, she'd wish she'd done the same.
Yeah, we just had CPI come out just yesterday or the day before this podcast, which came in just below expectations, which was really quite surprising. I don't think anyone thought that.
No.
With inflation at target, we've now got the probability of a rate cut in March, which was once at 50%, now down to 20%, so very unlikely to happen. Yeah. We're really looking for June as the first interest rate cut. That's with the expectation that inflation picks back up between now and then, and they're having to cut rates in order to keep things afloat.